Marketplace Books and Traders Library are proud to present the Trade Secrets video series. When you're looking for new ways to boost your trading returns, these best-selling resources will give you the tactics, strategies, and ideas that will transform your trading. These books and courses give you the knowledge of highly respected educators like Jeff Greenblatt, author of Breakthrough Strategies for Predicting Any Market, Charting Elliott Wave, Lucas, Fibonacci, and Time for Profit. Oliver Velez, author of Strategies for Profiting on Every Trade and 5 Tactics That Beat the Market. And Tony Turner, author of A Beginner's Guide to Short Selling. All of the courses in our Trade Secrets video series are supported with an educational online manual. With this manual, you can observe the charts up close. And with our website, you can access this valuable resource at any time. Just log in at traderslibrary.com/trade secrets. Traders Library and Marketplace Books also feature a myriad of interactive multimedia courses in our Traders Education Corner. These course books come complete with the text, interactive test questions, online video presentations, glossaries, and downloadable charts. Make sure you visit traderslibrary.com/TLEC to learn more. To make sure you get the best price on these profit-boosting DVDs and all of your other trading resources, go to traderslibrary.com and sign up for our Rewards Weekly program.
Good afternoon. Welcome, everyone. It's nice to be back. It's been several years since we've been on the circuit, and we're excited to be here with Traders Library and share some of the information that we have for you. I think all of you here today, let me just first see a show of hands. Is everyone here an active trader? Good, so everyone here actively trades. Do we have anyone here that's never placed a trade before, that is just trying to gather up information and figure out what to do with this mass of information that we have in the markets? No, good. Okay, so we have all experienced traders. Great. So then everything I'm going to talk to you about today is going to be very relevant for you and what you're doing. So first, let's just talk about what today's agenda is going to be. We're going to talk about the current situation. We're not going to get into great detail about the current situation, but we are going to discuss what's happening so we can understand why it's so important that you take care of your own money. We're going to understand what the market really is. We're going to talk about how you can trade better with chaos and the science of chaos. We're also going to understand what the market alligator is. And we have, this is a smooth moving average that my father discovered many, many years ago. It's a tool that we use to understand how to be on the right side of the market at all times. The next thing we're going to talk about is the wise man counter trend trade. The next is going to be the fractal trade, the Super AO signal, find the right trading arena for you, and learn why 90% of traders fail. And the last but not least is the most important is how to be in the top 10% of successful traders. Because I think that's why everyone's here. We're all looking for a way to trade better. Click. May you live in interesting times. This is something that I grew up hearing from my parents, and they used to talk about it being a Chinese proverb, but I think if we think about today what interesting times are, it could be a curse. We want to look at gold has hit all-time highs of over $1,200 this year. We've seen crude go from $144 a barrel back down to $32 in less than 7 months. We are seeing the national deficit is in the trillions and adding up. We're seeing the financial bank crisis bailout, all of these things that are going on. We hear in the news. There are too many of them for me to discuss or to name names or to even try to identify what is happening. I think even if you have an MBA in finance, to try to really understand what is going on in the financial crisis today is kind of difficult. The next thing is the home loan and commercial loan crisis. I think almost everyone here, show of hands, do you know someone that has a house in foreclosure? Yeah. So we're seeing a lot of things that we never think that we would see in our lifetime are going on. And the financial situation is very scary. We also have the big credit card debt crisis. I think right now credit card debt is, of course, larger than it's ever been. We are seeing interest rates going higher. I think the average interest rate for an initial credit card is 14.5%. And I think the average debt I have some notes here, the average debt per household is over $16,000, which really isn't much. The average number of credit cards per person in a household is 3.5. So we have gone from times when we used to live and pay for things we owned to now we're in a society where everything we have is on credit. We're trying to borrow, beg, or steal, depending on where you are, to get ahead. What we want to do here today and what we want to talk about is how we can take care of our own financial situation, how we can understand what's going on, how we can look at the markets and see what's happening. By the time you see the news, or you read the news, or you've listened to the news, it's old. It's not news. It's old. It's already happened. It's too late. So this is just a chart I wanted to pull up. First, I'm going to show you one or two charts, and then we're going to get into some other things about how our signals work, what they do, how we apply them in the market. We're going to look at some stock charts. We're going to look at some commodity charts. We're also going to look at some Forex charts. And we're going to look at ETFs. One of the things about our methodology, which I think is amazing, is that we work in all the different markets and all the different time frames. Now, there will be markets and time frames that we work better in, just as any system will work better or may not work as good. But we are able to get in them. Back, about 18 years ago when my father first started teaching, he had people would come into class and we'd be talking about the markets and we would go over all of the charts that we looked at. And at that time, we were strictly commodity traders. That's all we traded. He had a few stocks that were investments, but as far as active daily trading, we traded commodities. And I remember him sitting and telling people that gold was going to hit $1,000 to $2,000 an ounce in the next 20 years, and people thought he was crazy. And it's interesting, I get emails now every so often saying, Bill was right, he knew what he was talking about. So what we're seeing happening are things that we never imagined that were going to be happening. At the prices of gold, we've seen a 400% increase. Gold has been, since the gold was devalued back in Nixon's days, everything has changed as far as what used to be the financial tie between gold and the dollar. Crude is another good one that shows you what kind of, I don't want to say a mania market, but what we have really seen in the markets. These are not things that are driven by fundamentals. When you see crude go from $40 a barrel to over $140 a barrel because rumors say that we're running out of gold, start the markets moving, start the big players moving, start the market going in one direction, and then the market comes back down. I don't think anybody here can really tell me logically how crude can go from $140 to under $40 a barrel in 7 months. There isn't a logical reason for that. But what we do know is that the charts will tell us what to do. So even when I look at this chart, and what we're going to show you today is how if you'd have been in gold, we would have been able to take the opportunity to have been in this market all the way up and back down again. Yes?
Could the chart have possibly told you at the top the magnitude of the swing down?
No, the question is, could the chart have told you at the top the magnitude of the swing down? No, there is no way for any chart to tell you the magnitude. If anyone can tell you that they know where the market is going, I would have to say they're not telling you the truth. Nobody knows where the market is going. The reality is the market is where it is because that's where it's supposed to be, period. So the reality is what we make it and what we perceive of it. So in this case, we have no idea how far the market was going to go. All we know is that we want to, if the market is a dog, I want to be its tail. And I want to follow it wherever it goes. Now this is going to be a very important question for everyone. If you'll take a moment, I think everyone here has a pen. Let's say I'm an alien and I've never been to Earth before, and I come to Earth and I land on a farm, and the person that I happen to meet excuse me, is a veterinarian. And so I understand farm animals. I know what animals are, but I really don't know anything about humans or anything else. So if I were to ask you, what animal personifies the market to you, take a moment and write that down, or mentally think about it. What animal personifies the market to you? Anybody? What animal?
Tiger.
A tiger, right? So a tiger, you think of a tiger being aggressive, mean, scary. Fast. Okay, fast. You?
Chameleon?
A chameleon. Excellent. So the market, a chameleon, meaning that it can change its color at any time. 1 minute it's green, the next minute it blends in here. Someone else, a different animal.
Monkey.
A monkey. And what does that represent to you with the monkey?
Crazy.
Crazy, all over the place. Someone else with a different animal.
Shark.
A shark.
Gotta eat you alive.
Yeah, so, a lot of us do see that as a shark. Anyone else? Anyone see the market as not a scary animal?
Wait in here. Shark because of what reason?
What was your reason for shark?
Gotta eat you alive.
Scary, eat you alive. It's a hunter. It never stops moving. It's always cruising. Yes?
Fox.
A fox. And why does it personify that to you?
Because a fox it takes opportunities, but it knows when to hold up and it knows when to go out.
Sneaky.
Sneaky, okay. And that, I have a picture of a coyote. Where we live in California, we have a lot of coyotes. And as we have very small dogs, and we understand exactly what tricksters they are, and they're also pack animals. And I like to think of, and this has always been my favorite, as a dolphin. But what the point is here is that almost everyone found the market as a scary animal. Right? The market is a scary place. And what we want to do, the market isn't a scary place. The market is what it is. It's what we perceive it. And our goal here today for you is to be able to let you understand a little bit more about the market, what runs the market, so that when you leave here, the market can be a little bit more warm and cuddly. Maybe it's going to be a puppy or a kitty cat or something different. But we want the market to not be a scary place. We want it to be a friendly place. When Einstein before I get to this slide, Einstein was once asked a question, and the question was, if someone could ask you, what is the most important question, what would it be? And his answer was, is the universe a friendly place? And so that is what we want to have the market become to you, is more of a friendly place. So let's talk about what's going on right now. Is this you? Typically, traders are in the top 10% of intelligence in the entire U.S. Or a country, I'm sorry, not U.S., in the world. They've also been previously successful in a business or some kind of endeavor. Typically, you don't see a lot of traders that come out straight out of high school and are trading. Now, I should say, today there's a little more likelihood of seeing that with the internet, but years ago, you didn't see that. Typically, most traders had some sort of success, had been very intelligent. They either had extra money, so you have to have extra money to get in the market, and then need extra money. This is something that I've added to, because we're finding today we need more 401ks, retirements. With the state of the union, let's say, things are changing. They're changing, and it's time for you to take control of your own money. One thing that I've always said is that no one will take care of your money better than you will. It's your money.
That's not what Obama said.
Well, we all have a right to our opinion, don't we? So even with all those things, you're in the top 10% intelligence, you've been previously successful in a business or a profession, you have extra money, and even with all of those, still equals 90% failure. In trading, 90% of the traders that come in fail. The percentages of successful traders are staggering. I mean, it is truly staggering, and typically, there's a lot of reasons for it, and we're going to talk about some of those reasons today. So current situation, what we want to know is this happening to you right now? Is this your current situation? You can't make consistent profits, and then when you do, you win and then you give some back. How frustrating is that? Or you're losing too much and too often. You've tried many approaches unsuccessfully, and you know you can be successful, but you have not found the correct trading approach for you. And you're tired of working to make money for others. Now, anybody here want to say that? You're tired of working to make money for others? Yeah, it's time to make it for yourself. So, how many people in this room right now would say that they could say yes to at least 3 of those? That's pretty good. I'd say over 75% definitely said yes to those. So what we want to talk about now is what the market really does. And I think this is important because a lot of people don't know what the market really does. The market is the best teacher that I know. It will tell you exactly when you are correct and exactly when you're not and how to fix it. And it's not biased. The market doesn't care. It has one job, and the job is to find an equal disagreement on value and an agreement on price. That's it. That's its only primary job, to find an equal buying and selling point between. Any questions on that? Now, what we can eliminate, here's a few things that typically, if anybody has watched any of the news networks or listens to anything, we have the bullish and bearish consensus. There really is no such thing as a bullish and bearish consensus. And I'll tell you why. Let's say, how many people in here think they should be long gold or bullish gold? How many people will be bearish on gold?
I almost asked you also address that question, in what time frame?
Doesn't matter. This is just a generalized question. How many people here would think that gold is going up and you would be bullish in gold? You're not in the market. Okay? So I've got four people that think that gold is going up. So let's just say that let's just say that those 4 people think it's going up. So we have a bias for bullish on one side. Now, that's just in this room. Really, if everyone else that didn't answer that question is bearish, then we have a higher bearish consensus. But it really doesn't matter what the consensus is, because if none of you are in the market, you have no effect. Typically what happens is when you have a bullish or bearish consensus, you've only asked a certain percentage of people. You haven't asked the entire group. So you're just talking about that one group that you're asking. So the bullish and bearish consensus, we don't really think is a fair way of looking at the market, because it doesn't follow the market's job. The next thing is the overbought and oversold concepts. You know, we just said that the market has its primary job is to find the exact place where there's an equal buying and selling pressure. So if that's true, an equal buying selling pressure, you can't have oversold and overbought. Now, you can't listen to the news for 5 minutes at CNN or FNNBC and not hear the concept or the words oversold or overbought. The markets are designed for that not to happen, especially commodity markets. If they were oversold or overbought, they would fail. We would have no markets. This is the only way that they can work, is to find that exact point. You know, and we looked at that gold chart previously, and the gold was up to 140. There was the end of buying power. What happened? There were no more sellers to sell for the buying. Market came back down. It's not an overbought or an oversold situation. It's an equal balance wherever the market is. For every buy, there's a seller. Excuse me. The next is most money management ideas. How many of you have heard, as soon as you place your order in the bonds, as soon as it goes $500 or in the S&P, put your stop in? No? No one's doing money management anymore? Well, I still hear of it, and I still have people call me all the time and say, you know, I've got the system. As soon as this happens, I need to place my order. I can't let it go this far. We don't believe in that, because you're trading your wallet. Trading your wallet. The market has no idea what your wallet is, and it doesn't give you know what about your wallet. The market, that's not its job. So it doesn't care about that. So when we're trading the money management ideas, most of them don't really work with the market, because the market, they're trying to tell the market what to do. Now, I realize with some people you have to do that because you only have a certain amount of money to trade, and then you get limited and we run into some other avenues. But most money management ideas don't work. No questions? Chaos. Now, this is something, I don't know, I guess, how many of you here have read our book, or any of our books? Trading Chaos 1 and 2, New Trading Dimensions. So most of you are new to us. For those of you that read our book, some of these concepts will be a little bit easier for you to understand and kind of follow with. My father has a background in engineering, nuclear thermodynamics, psychology. He is a multifaceted, amazing man. And through his years of learning, teaching, and doing things, when he started trading for himself, one of the things that he started looking at, he started trading like everyone else, lost tons of money, read every newsletter, watched every show, started managing money. He did the entire gambit that most of us have done. And then he started looking at some different things and applying some of the information that he knew from his background. And the science of chaos was one of the things that he started looking at. Typically and classically, we all know, science for the last 2,500 years, we have been learning. We first thought the world was flat, the world wasn't round. We've had a lot of innovations that keep coming. We have internet, we have many different things that have created this vast world for us to kind of draw from. But with the science of chaos, what happened is we found out that the typical history of chaos, or the history of science, which for over 2,500 years, we were feeling like we had this ladder of wisdom that we were climbing up, to find out that the ladder was kind of leaning on a building that really wasn't working once the new science of chaos came out, instead of the history of science. So at that point, we had to do some readjusting in how we were looking. One of the things that Einstein left with us before was the constant of the speed of light. Well, since that, we found out there's little things called leptons, and these leptons can travel 16,000 times the speed of light without even losing any energy from one to the other, going around. So there's all of these things happening that we aren't aware of that are so minute around us. So what we found out with chaos, and what most of us think here when we think about chaos, you think about, oh, it's chaotic, I'm having a chaotic day, everything's just, it's all chaos. Chaos really means the opposite of that. What chaos means technically is letting new information. That's all, what the new information, that's what we're looking at. Now, we have two choices of handling that new coming information that come in, because we have this coming at us all the time. One of them is to massage it, distort it, and fit it into old categories, which creates boredom and overwhelm. And just think of any time someone's trying to describe something to you. Well, then you'll ask, well, what did it look like? Or what was it like? Or did it smell like that? Or was the same color of? We're always trying to describe it being like something else and putting it into an old category, as opposed to maybe allowing that information to come in and let it organize itself. So that's the first choice. And the second one is let that new information come in, which that means letting go. And the letting go is where we're all kind of afraid, and that's where we have the problems. Now, this is how a small example of what I'm talking about, of the new information and letting go. Right now in this room, there's hydrogen and oxygen, those two atoms. They're some of the simplest forms. The hydrogen atom has an electron and a proton. Right now in this room, there are trillions of them floating around. Trillions. And at the same time, there are trillions of oxygen atoms floating around. But 99.999999% of the time, when the hydrogen atom bumps into the oxygen atom, it decides to keep its form. 0.000001% of the time, when it bumps into that, it decides to let go, which means it doesn't know what's going to happen. And when that happens, these two come together and they form they form water. So the hydrogen and the oxygen have now created and had a transcending experience. So they went from being a simple hydrogen to a simple oxygen atom to now, by letting go and letting them organize together, they're now water, which is something much more incredible than either hydrogen or oxygen is separately. So we come back to the most important question: what do we do with the new information? Do I fit it in the old category, like the hydrogen atom that's going to keep itself? Or do I let it organize itself and become water? One of the things is the market. We talk about power versus force in some of our teachings. And the market to us is power. It's not force. We're the ones that put force against the market with the power. So this is a slide. Opportunity. When you read that, we read nowhere. Correct? Opportunity is nowhere. And we like to think that opportunity is now here. It's how we look at things. It's how we visualize. Our perception, our glasses that we look at the markets are what create our results. The same with our life. Everything that we see, our experiences that we have had are what create who we are now and how we react. If, let's say, you've been in the S&P and you had a huge hit and lost $25,000 in 5 minutes. You're in a day trade, boom. Now, do you think the next time you go to get in the S&P, you're going to feel as good about that trade as you would say if you were entering a trade in the gold? No. First, the market owes me. You're scared. The market owes me. There's a number of different things that go on. But because of that experience that you've had, it changes your view of the market. When the truth is, the S&P is no different than the day before, or the day before, or the day before. It's the same market. But your opinion of it has changed, which will then in turn change your results. So one of the things that we like to use, this is my little friendly alligator here, we have decided that we needed more help years ago of how to understand where to be in the market, what side of the market to be on. The markets, for many years, we had beautiful trends. Our second book, New Trading Dimensions, you would find that trending markets, we had multiple signals, we were making tons of money, it was easy. And then all of a sudden we started seeing some changes occur in the market. Changes were occurring with the volatility, with the types of markets. We have 24-hour electric global markets, we've got Forex markets, we have lots of stuff going on. But one of the things through all of this is that we have something called the alligator, which has kept us the ability within seconds to look at a chart and know what side of the market that I want to be on. So the first use of the alligator would be its integrated approach to monitoring the market's momentum. The second is a simple indicator to trade only with the current trend and to identify counter-trend trades. The third is it's a protection device to not lose money during bracketed markets. How many of you have experienced trading wave fours? Corrections. Sideways. Then you all shouldn't be here. If you have not incurred that, you should be on your yacht somewhere. Well, I have been trading over 17 years, and I have seen upside down, sideways. I've seen quite a bit in my time. I remember trading when I first started where I used to call my broker, and you place your order, the good old days, and you actually talk to someone on the other side. Those days are over for most of us. So the alligator anatomy, I'm going to tell you a little bit more about the alligator and how to create it. This is something that you, depending on what your software is, you might be able to program it yourself. The alligator is a smooth moving average with an offset into the future. It consists of 3 lines. The first one's going to be what we color the blue line. And we call that the jaw. So when we think about the alligator, we have the jaw, the lips, and the teeth. And so in the theory of this, in the wisdom of my father, was looking for something so that we could visually see what's happening. We wanted to get away from such technical and be more visual, be more right-brained with our trading. And so this is how the alligator came into play with these 3. So when the alligator opens his mouth, you know, he's looking for looking for food, we have a trending market, it's open. When the market is closed in a bracketed market, that's when the alligator is called sleeping. So we have some terms that we've used through the years with this. So the blue line is the jaw. It's a 13-period smooth moving average offset 8 periods into the future. The next one is going to be the red line, and that's the teeth. And it is an 8-period smooth moving average offset 5 periods into the future. And finally, the green line, which are the lips, they are a 5-period smooth moving average offset 3 periods into the future. So these 3 moving averages put together are what create the alligator. Now, for some of you, let me finish. The blue line is also going to represent where there would be no new coming information. So if there was no new coming information into the market, you would see the price bars rest near the area of where the blue line is on your chart. Now, if the blue line represents no new coming information, and that would be where it is on that chart you're looking at. The red line comes into play. If there were no new coming information, the price would represent where it would be on one significant time frame lower. So if we were trading a daily chart, then about roughly a 60-minute chart would be where the red line would be. The next is going to be the green line, and it represents the price where there would be if there was no new incoming information on 2 smaller time frames. So here it puts it on about a 5-minute chart. Now, the question everyone always asks is how many data sources and things do I need? 1 data source, computer mathematically figures this out. Yes, question?
Is the green line 2 smaller time frames from the blue line or 2 smaller time frames from the red line?
Each one goes smaller. So the blue line is current, the red line's 1 lower, and then that's 2 smaller from the red. So it comes down. And it's a rough estimate. It's not. So let's say we're looking at a 30-minute chart. You know, roughly you'd have a 15 and a 5. So it can be varied to what you're looking at. But it is not exact, but roughly what would be happening where there would be no new information on the other time frames. Now, smooth moving average, I put this here because through the years, this is one of the questions I get more than anything is what is a smooth moving average? Can my software program can it program this? So to create the smooth moving average, instead of subtracting the last entry, you would subtract the average of the last number of bars. So the smooth moving averages were created by a mainframe computer that took millions of iterations to identify and confirm the numbers. They also just happen to be Fibonacci numbers. So this was not something that we actually created the mathematical part for. About over 20 years ago, my father hired some mathematicians that had a mainframe computer. And because it was so expensive to use this mainframe computer, they actually had to hire them, and they were working like in the wee hours of the morning to get some hours in there to start doing these computations. So this took, I don't know, I believe we spent over $50,000 trying to get these computer iterations to come together for us to find out where they would be. And what they, again, when they came out, they happened to be were Fibonacci numbers. That wasn't something that we planned, something that was put in there or we made up. It just happened to be that's how it came out. And I mentioned before, only one data source is required. So you don't need multiple data sources in order to create the alligator. Yes?
The moving averages are based on the closing price, right?
Some moving averages are, yes. These moving averages, and I apologize I did not add that, it is based on the closing price.
Closing price.
Yes, the closing price, and that is important. Because they'll either be midpoint or closing, and these are from the close. Had to have a little fancy graphics for you there with the alligator coming in. So this is basically what we're looking at. We're talking about the alligator on a chart. Now I've been told to walk up close and do this, so I'm going to follow directions, I think. So when we're looking at, this is where I was talking about that corrective market or an intertwined market. Anytime the market is not in a trending period or pattern, it's clear. It's so visual. We can look in seconds and see that the market is not in a place where it's trending. Now, this is where trending markets come out of. It used to be, many years ago, that that's where almost all of the trending markets came out of. Unfortunately, or fortunately, there's so much more volatility in the markets today that we see very few what we call sleeping alligators. They're few and far between. But when we do see them, we know to pay attention. So in this particular chart here, we see this is the sleeping alligator, and this is a hungry alligator. This is the alligator opening up, and it's obvious when we see this, what side of the market do you want to be on here? You'd only want to be long. In this point, I don't have an opinion. And that's what the beauty of this is. I don't really want to have an opinion about where I want to be in the market. I want the signals to come out, and I want the market to tell me where to be. And so in here we had a trending market up, we had the market pull back into a correction, and the market take off again. Now, I am I'm not an Elliottian, but I've been looking at Elliott Wave for many, many years. So sometimes I think in terms of that. I don't trade it, but I use the Elliott Wave and the underlying structure just to tell me when to be aggressive and conservative. So one of the things we look at here is the AO and the Elliott Wave, and we're going to get into that in a few slides and tell you about some of the other abilities that we have in looking at this. But it's really clear, I hope, to everyone here that we have a correctional market or a non-trending market. Alligator opens up, we have a trending market. And again, so when the alligator is wide open, the only place we want to be is long. Now, when the alligator turns around, of course, in a short market, it's going to look the exact opposite. So a fractal definition. One of the things we want to do is I want to tell you or explain to you what some of the signals are that we use to get into the market. Whether you plan to work with a profitability approach or learn further from us, what we want is for you to be a successful trader no matter what. We know that our system may not be the system for you. It is the system for some people, but having some basic knowledge is going to help you no matter what way you decide to go. A fractal is a change in behavior. Now, we use fractals and have been using fractals since the beginning of our trading. This is one of the things that has not changed. So the first book was written 94, I was going to say 94, but it's 95 before it came out. So fractals have been used many ways through our progression through the years. If you've read our books, you'll see that we've had leveraged and we've had several different ways of using a fractal. But the fractal has been a solid and true signal since day one. Fractal, a sequence of 5 or more bars where the center bar or group of bars is preceded by, followed by 2 lower highs. Let me make it really simple. Put your hand up. Middle finger. That's a pristine fractal. That's what we're looking for formation-wise. The tallest and 2 lower highs on either side. Now, there can be inside bars in between, but you must have the middle with 2 lower highs either side. Turn it upside down. You've got a cell fractal. And this is just an easy visual way for you to remember it. So a cell fractal is going to be the opposite of a sequence of 5 or more bars, where the center bar or group of bars are preceded with or followed by 2 higher lows. So it's real simple. In a fractal, no matter what software you're using, even with candlesticks, bar chart, period, anytime you see a point sticking out, you pretty much know you have a fractal, unless you have some equal bottoms. There are a few cases you don't, but most of the time it's a fractal. The other is it takes at least 5 bars to create a fractal. So this figure of the hand, that's a pristine fractal. You can have more bars in between. In between every degree or every fractal is a degree of Elliott wave. So between every fractal is a degree of Elliott wave. Now, fractal signal rules, we want to know a little bit about that before we start looking at the charts. A valid fractal buy must be hit above the red line of the alligator. So you know with the alligator, we're talking about the red line, we just mentioned that would be the teeth. So we don't want to go long, we wouldn't want to buy anything unless it was hit above the teeth of the alligator. Now, where the fractal is formed may not be above the teeth. Where it will be hit and initiated needs to be above. And that's a key point. A valid fractal cell must be hit below the red line of the gator. So the same as the opposite. We want a cell. It must be hit, not necessarily formed, below the red line in order to be a valid fractal cell. Now, there is an exception. When you enter with a counter trend signal, which we're going to talk about, then you can take a fractal from any location. And again, any of you familiar with our books will understand how that actually works, where the exception rule comes in. And the other is that once a fractal has been hit, it is not valid to be taken again. So if you had a fractal signal, market comes back, retraces it, takes that price out, we do not place that order again. It has been used. Any questions?
The fractals, that's a reversal bar then. Because it's going to reverse from the fractal.
Not necessarily. The fractal actually keeps us in, is more of a trend. The reversal bar is going to be that counter trend trade. So the reversal is going to be the opposite. And one of the reasons we've come up with the counter trend trade is because in the past we only used fractals as our first entry. And many times with taking a fractal as your first entry, we were getting in a little bit late. So let's say we have a fractal here, the market comes up and hits it and then retraces, and we were seeing some losses. So we were trying to figure out, with the changing of the market, how do we participate earlier? How do we get in that market and still be able to use the fractals as an additional signal? But we want to be there for buy in the high, sell the lows. We want to be able to be there in the trends and the counter trends. And so as we get further today, we'll kind of show you a little more about that. You had a question?
Yeah, my question was, is what you call fractal, is that what some people call a pivot, like a pivot high or a pivot low? It moves on that point.
Yes, the question was, is what we call a fractal a pivot high or pivot low point? It can be. I'll be very honest with you. I am Profitunity pure. I have never strayed. I have never learned another course. I know very little about candlesticks. I know very little about others because this is all I've ever known, kind of one of those. So, I understand there's Head and Shoulders and Bollinger Bands, and there's many things out there, but yes, to your question, but for us a fractal is different. We don't necessarily call it that because we're actually going with the trend.
Thank you.
You're welcome. So here's some more fractal examples. I gave you the pristine fractal example that looked like my hand, but this is going to give you kind of a little bit better idea of what the fractals look like. So everyone can see here we have the pristine. Excuse me. Everyone can see we have a pristine fractal here with a buy with the 2 lower highs on each side. Now here in example B, we have a fractal that's both. It's a buy and a sell fractal. C is a simple sell fractal. D gives you a setup where you have a buy and a sell, but they're not on the same bar, but they're both there. And then, of course, E is just showing you here, this is a common question. Those have equal highs, so that didn't create a fractal until until that bar came in and gave it the second low. So the fact that we have an equal high here doesn't negate the fact there's a fractal. It just means we need another lower high in order to create the fractal. So you can have equal highs or in there, they're not really an inside bar, but an equal bar to still create your signal. Now this is just an example to show you fractals on the chart. We use CQG personally for our trading. We have our indicators programmed for several other trade or software packages, but we have always used CQG, love CQG, and I hope that I will never have to live without it. It's got some very neat features, but in the program, our indicators are programmed with them. So where you see these green triangles, those would be fractal bias signals. They are placed a little bit above the actual signal because sometimes we have more than one signal on a location, and so in programming it had to be that way. So these green triangles, all of these are fractal bias. The red triangles are fractal cells. Bi. So they're very clearly labeled, but even if you didn't have a software program to show that, how easy is it to see most of these? I mean, it's easy to see the major ones, and some of these inside ones you'd have to take a look and see if they're there. But between every fractal, we have some degree of an Elliott wave as well. Any questions? Okay, the wise man signals. Now we're going to talk about our next signal in the market. We have 3 ways to get in and 3 ways to get out. And that's it. We like to keep it simple. Through the years, we have been extremely complicated. We had 6 signals getting in and 3 getting out. And as time's gone on, we found my old nursing teacher used to say, thing called KISS, keep it simple, stupid. And I always remember that. The simpler that we can keep it, the better. That as humans, everything we touch, we tend to overcomplicate. We don't seem to be able to help it. Yes, we have a question?
Sorry. Going back to the previous slide, where there's a fractal bias or a fractal cell, I guess, is that where you would make entry? And if so, what are your rules around it? Where would you set your stop?
Sure. The question is where you have these fractal bias and cells, would you enter on all of them, and what are the rules around it? And that is what we're going to get into. No, we would not be buying and selling every one of them. One of the basic rules is that we're only going to take a fractal buy in an uptrend above the green line. We can't take a buy below, and we're only going to take a fractal sell if it's initiated below the red line. So those are the rules as far as the fractal goes. Now, the next indicator that we use, we call the wise. We have our latest book, Trading Chaos, 2nd edition, has all what we call the wise man signals, and they include the fractal, the super AO, and the bullish or bearish divergent bar. So we're going to be talking about this wise man signal here, and this is a counter trend trade. So as we were just looking at the fractals, those were for trend trading or for adding on. But many of us know now that we're not seeing just trending markets. I mean, how often do we really see a true trending market? Not maybe 1 out of 10 compared to what we did 4 years ago. So we have to be able to find a way to get in them earlier and have less risk. And that is the counter trend trade, which is the wise man. So if we're correct, we get the best possible entry point in a new trend. There is not a better entry point if we're correct with this signal. The risk on the trade of a divergent bar is going to be the length of the bar. So wherever the bar is, whatever the length of that bar, monetarily, dollar-wise, that's what your initial risk is to get into the trade. The next is the signal must be below the alligator for a bullish divergent bar, and the signal must be above the alligator for a bearish divergent bar. If we're talking about a counter trend trade, I'm going to be trying to sell the highs and buy the lows because I am in the counter trend. Now, this is what we call the gambling phase. If we had 3 phases of our trading, we would have a gambling, a trading, and investing. This would be the gambling phase. This is where we don't know, but if we are right, we are in the best possible trade location. So based on that bar, based on the risk of that bar, and if it makes sense to us, and something else we have called angulation, we will decide if this is a trade we want to enter with and initiate a campaign. Now, the other thing is you must have at least 3 bars outside the mouth, and this is what we're getting to is something I call angulation. Just because we have a bearish or a bullish divergent bar doesn't mean it's valid. The same with the fractal. There are some parameters around the ones we will take. Otherwise, you're going to be in and out, in and out, in and out, in and out. There's tons of fractals, divergent bars, but let's get some parameters to kind of scale down and get a better percentage-wise of what could be a profitable trade. Angulation. And the angulation is what we're really talking about here is the bar compared to where the alligator is. We're looking for movement. Whoop. Okay. So the bullish divergent bar, to determine if you have a bullish, we're going to compare it to the immediate preceding bar only. So as you see here, we're looking at this bar compared to the immediate preceding. That's the only bar we care about in order to create a bullish divergent bar or a bearish. We're only looking at those two bars. The next is the current bar must have a lower low than the previous bar, and the current bar must close in the upper half. So what we're saying here is we want to know who's in control. One of the things that we look at in these bars is that who's running the show. We use the straight price bar, open, low, high, close. So I have 4 bits of information. I know where it opened, where it closed, how high they took it, and how low they took it for the day. With that information, I also know who's in control of the market. So if the buyers have opened the market and took it all the way down and brought that all the way back up, who closed the market? The buyers were in charge of the market. They ran the market. So that tells me where the market is willing to close. Tells me a lot more information of what's happening. Where was this market willing to settle for the day? And who was in control? Buyers were in control. So the next thing I look at when I get that, again, is do I have angulation? I'm going to go over the divergent, the other bearish side, and then we're going to talk about or show you some angulation. So to determine if you have the bearish divergent bar, we're going to do the opposite of a bullish divergent bar. So here, to determine if you have a bearish divergent bar, you'll compare it to the immediate preceding or previous bar only. The requirements are opposite of the other. The current bar must have a higher high, and the previous bar, then the previous bar, and the current bar must close in the lower half. So the same thing we're saying here. We're saying when we're looking at this bar, who is in control? Buyers opened it up, sellers took it down, and who closed that market? The sellers closed that market. They were in control at the end of the day. That's where the market was willing to settle and find its price point was on the close, on the low, almost on the low. So now when we look at a chart, divergence, now when we look at a chart, we want to look at angulation. We said we had to have at least 3 bars. This is a very mild situation. Divergent bars here are shown with CQG. We'll have a green round circle. So you'll see the green round circle will mark them. Remember, in order for it to be valid period for a buy, it must be below the gator, and there must be at least 3 bars outside the mouth. So we're looking at 1, 2, and 3. Bars are coming down, the market's going sideways. We view that as having some angulation. The other way we think about it is think about a rubber band. If you were to stretch a rubber band, the further you stretch it, the further it goes. And we'll show more. But the further away this divergent bar is from a market like that, the more angulation you have. So think about that rubber band trying to sprout. Now up at the top, again, we have divergent, divergent, divergent. Look at the difference in the distance between the price bars here and then here. Do you see the distance? That's giving us that angulation, that pull, that stretch. So that would be a divergent or bullish or bearish divergent bar on the top, and it's also what we call a 3-3. We label the bar a 1, 2, and 3 based on, if you take a price bar and you split it into thirds, the first top that would be 1, the middle third 2, and the bottom third 3. So on this particular bar right here, it's almost a 3-3. It's a very strong bearish divergent bar. I saw some hands for questions.
So the angulation really is just based on the number of bars, right?
No, the question is the angulation based on the number of bars? No, the angulation is based on the number of bars, the distance, and that stretching factor between where, in our books how we categorize it is we're looking at the difference. If you were to draw a line, let's say we're looking at this bar here. This is the first bar that started that move. Does everybody agree?
Yes.
Okay, so the move started here. So I would imaginary draw a line. Visually, I draw a line from here to here. Now, I want to see what's happening here. Between the red and the blue lines, if I were to imaginary draw a line where they're crossing, it kind of looks like this, doesn't it? So there's some angulation happening there. So when I put those together, I've got a 3-3. The risk on that is very small. That's the other consideration. If I'm going to have an initial trade, I don't want my initial trade, typically let's say we're trading a $25,000 account. I wouldn't want my initial risk to be $6,000. That doesn't make sense. I want my initial risk to be something that's going to make sense for my account size of getting in. So that's something else we look at. That initial risk was something that was feasible. Yes?
The bar next to the red circle up there, yes, the one you pointed to, could that be perceived as a bullish divergent bar?
It wouldn't be valid because it's above the alligator. You see that we would need this to be here. So it technically would be a bullish bar, but it's not valid based on its placement.
Okay.
So yes, you did see the correct formation, just not in the right place. You're welcome. Next question.
The bullish divergence bar, I guess, obviously it worked and everything you can see. The green circle.
Yes?
Since
Oh, here, I'm sorry.
Yes, it's so close to the alligator. Would you say it worked, but there really was not much angulation?
Absolutely. The question is obviously it worked, but there was not much angulation. No, this wasn't. I actually pulled this chart more to show where the bars were. What we're going through with each one is the green circle is a buy, red circle. So as we go through charts, we're going to see some more examples. This would not be the best example of angulation here, but it is valid and it does meet the requirements.
And it's tradable.
It is tradable, yes. What you'd have to question here, of course, would be what the length of that bar and was that risk something that would be comfortable for you. Something I have to explain here, in order for me to create these charts, for you to be able to see them, I have to blow them up. So when I blow them up, as you know, it starts to change some of the angles and some of the distances. So some of these charts look very different and look more angulated and look better when they're in their normal form. But also, as you know, to try to go through and find multiple examples of just single pieces, is not always simple. So we'll see as we go through, and any of these charts, as you have in your book, are named. You're free to go home, look up the chart, and take a look and see how it plays out in something that's not been distorted size-wise. Yes?
And just to clarify definition, if something were in the mouth of the alligator, then it would be, the bars would be forming or part of it would be inside between any of the bars, the green, red, or blue bars. Is that correct? If it's in the mouth, but if it's being outside the mouth, it's either bullish, it's below all three bars, or if it's a bearish, it's above all three.
Right. I think the question is that if you have bars inside the mouth, you can't have a bullish or bearish valid bar.
For definition, you said that for the Wiseman or whatever, it has to be outside the mouth. So.
Oh, okay.
So what's outside the mouth is either below all three bars or above all three.
Yes, and now let's say this bar was in the mouth, but the low is out. That counts. I need 3 lows coming down outside. I need 3 highs coming out upside. You may have one of them going through it, but is the end of that bar out of the mouth? And again, this is something that is visual, and it's probably the most subjective part of our trading is finding these divergent bars. Because this one may work, or this one, I think I see angulation, I don't see angulation. This is where I get the most questions from our clients and non-clients, is how to define the angulation. And, one thing you need to know about trading, do any of you play music here? Any of you musicians? Okay. Do you remember when you first started playing music, how you had to learn how to read music and had to learn how to read a note and how to play that note, right? So you learn how to play a note, but if I put down a sheet of music, could you play a song? No, not right away. It took you a little time. So you understand, the notes, you can read it, you know what it's supposed to be like, but it took you time to refine and to get your skill level to where you'd want to play in front of other people. Same thing with the market. The same thing with our way of trading is that your signals are your notes, and as you practice, as you get in part of the market, you start to learn how you play best. So in this process, there's a lot of trial and error. And as I mentioned in the beginning, 90% of traders fail. What we have tried to do for my father's been trading over 50 years. He is 78 and he still trades every day. His percentages are well over 300% a year, every year consistently. So this works. We've been seeing it work a long time, but I have worked with probably close to 2,000 traders, and I have talked to more than 10,000 in 17 years of doing this. And it's the same thing over and over. Trading is 99% psychological, or 98 to 99, and 1 to 2% technical. And for those of you, I think everybody here has traded, should know that's true. When you talk to someone who has never traded and you tell them that, they think you're crazy. Well, try it. Get in there with the market going against you with multiple positions and tell me that it's not psychological. Any questions before we move? Yes?
Blue bars, what do they mean?
Good question. Okay, the blue bars. I want you to know I have a lot of material I was trying to give you today, so I'll be happy to explain them to you, but I didn't put them in the paper. The blue bars are what we call a squat bar, and this is information that you can find in our first book. A squat bar, we're looking at the bar compared to the immediate previous bar, and basically what we're doing is range divided by volume. It's like tick volume. We're trying to see how much movement is happening in there, gas mileage. So when a bar comes up, a blue bar, which is a mathematical calculation the software does for us, think about a squat bar as the market squatting. And after the market squats, somebody's typically going to jump one direction or the other. So it's
a smaller volume bar.
Yes. So what we see in here, squat bars typically will be in one of the top 3 or bottom 3 bars as a trend-ending bar, 85% of the time. So 85% of the time you will see a blue squat bar, or we color them blue, that will be either one of the bottom 3, which I mean bottom 3, next to this, next to this, next to this. It will be there at the end of a trend. So when we're looking at these counter-trend trades, the bullish or bearish divergent bars, and we have a squat bar close, it's more intriguing. It's just one more thing that kind of helps us look at it. And we're also going to talk about the other, which is going to be the AO. So squat bars are a bar that tells us it's basically range divided by volume, volume compared to the immediate preceding bar, and if it meets the requirements, our software paints it blue. Yes?
That red bar at the bottom, would that be the entry bar or would it be the trigger bar to enter the next bar?
The question is, okay, the question was here, is this red bar going to be the entry bar or would the next bar be the trigger? Is that correct?
Yeah, would the red bar be the trigger bar or?
No, the next bar. What we do with our signals or our indicators, if we decide that that is a valid bullish divergent bar, we would place a tick, we would place a buy 1 tick above the high. And then it would be executed in the next trading. Next bar. Right, next bar, next session, if it's an intraday chart, it would just be the next session. Okay, so here's a little bit more. We talk about the angulation to give you a little bit better visual of what's happening with angulation. And again, of course, we're a little stretched here. But when we're looking at this chart, we see this bar here. We've got bars coming outside the mouth, alligators running sideways. We have angulation. Does everybody agree that there's angulation on that bar? And it's almost a 1-1. Who is in control at the close? Absolutely. The buyers were in control. So we have a bullish divergent bar with angulation. The risk on that bar was fairly low. Now, you take that bar, you have a little slippage as you enter the next day because it opens above. There, market goes up, and we get another divergent bar. Now, this is an example in a correcting market. When we have corrections, when we have the sideways markets, when it's intertwined, typically we'll see, or a range-bound market. Market goes up and down, up and down, up and down, up and down. The way to know that is because your alligator is going to be doing this. Visually, I know. So in those, that's not a place that I'm trying to trade the trend. I'm not trying to add on. I'm not trying to be a genius. If I'm trying to trade the area where 85% of your losses occur, I'm going to be conservative and I'm going to be quick. So in this case, if I got in here, I have a bearish divergent bar. I'd either reverse or exit there. Yes?
Would one of your SMAs be the predominant one? Because if you look at the first one, they're kind of like mixed, and then you got the top one, which is closer to the blue, but then at the bottom one, you've got convergence of all of them.
Right, the question is there a predominant of the three smooth moving averages? That you have the convergence and they come apart. So is there a leading one, basically, is what you're saying? Not necessarily. In a trend, of course, the green line is always going to be leading and closest to your price bars because it's the 5-3, so it's the least of the averages, so the 5-3. But there is not anything that's going to tell you what's happening in that correctional mode. You'll find them right on top of each other, separated. They stay pretty close, but there is not a leading one. Okay, so after we have this bearish divergent bar on the top, which also is a squat bar, market comes down, and we get a huge bullish divergent bar again. Now, the risk on that bar, chances are, most of us would not have gone long there. Right? But if you had gone short from here, would you be happy to take your profit? Yeah, that's not a bad move, is it? From 99 down to 93. That's 600 points. It's a good amount of money. So we wouldn't want to turn that down. Now, something that nobody has asked me, but I'm going to go ahead and answer, what are these the blue bars that don't end the trend? We call those a measuring squat. And a measuring squat's much like a measuring gap. What we do is once we've had a measuring squat and the next bar, 2 bars go past it, so we know it doesn't turn into a trend-ending squat, we then know that we call that a measuring squat. So from where the beginning of the trend started to the middle, we break that squat bar in the middle. Middle of that bar, we take that distance and we add it again. So it basically gives us a measuring squat of about how much more is there to go in this move. So in this particular situation, this first came out, that was your first measuring squat. The distance between, you can visually kind of do it, I can't really reach, but the distance between those two, and then you add that distance again, you see we continue with the same. By the time we get to this measuring squat, we take from the top to the middle of that and flip it, guess what we've got? That's almost exactly that amount of space through here. Again, what I haven't said in the beginning is I am a very non-mathematical person. I hate math. I failed college algebra 3 times before I passed it. I don't find math pleasing to me. I find colors and visual, those type of things are very interesting. So sometimes when I speak in more of my creative, it's this big or it's this far as opposed to how many points. I can get more specific if you need me to, but just so you know, I tend to think differently. I don't think mathematically. So for those of you here or that are going to watch this, you don't have to be a mathematician to trade. Absolutely not. Adding and subtracting is good. Yes?
When you said distance, is the measure the extreme to the close or the close?
Well, what we do is we would measure from the beginning of where the trend started, of that immediate trend. So this is where it started.
The extremes?
To the extreme. So to the extreme here, the high, to the middle of that bar, and then add that distance again.
Middle of the bar.
To the middle of the squat bar, yes. So we'd want to take it from the beginning of the trend to the middle of the squat bar, take that distance, and add it back. And see, and then if we have another measuring squat come out, we continue to do that till we've gotten to here at the bottom, market turn, and there was a trend-ending squat there.
Can you repeat the definition of a squat bar?
A squat bar is range divided by volume compared to the immediate preceding bar. So what we're looking at is it's like measuring gas mileage. So we want to see how many ticks, what's happening tick-wise per movement in that range. So we're seeing how many ticks in this bar compared to ticks in this bar. So we divide the range over volume compared to the immediate preceding bar to decide if we have a squat bar. And again, you can review that. If you want to read more about that, that would be in our first book, Trading Chaos. But do know that that doesn't represent what we're currently doing now. Trading Chaos second edition is much more focused on all of the indicators that we are talking about today. Information in Trading Chaos first edition is phenomenal on psychology, market structure, Elliott wave, things like that, but not current trading strategies. Okay, so are we okay here? Awesome Oscillator. This is something that we have been using for quite a while. Awesome Oscillator is a moving average. It's a histogram. It's a 34-bar simple moving average of the bar's midpoints plotted as a histogram on the chart. Now, we have been using this since the beginning, as far as I know, and it has multiple uses. The AO measures the market's momentum, number one, its primary use. We see how it measures the momentum. As momentum increases, what happens is I go in, I place an order. That order produces volume. That volume produces momentum and an action. So the AO is going to show us when that is happening. When new orders come into the market, the momentum will usually change before price. 8 years ago, 7 years ago, 6 years ago, probably 5 years ago, I would tell you the AO always moved before price. We are seeing such volatility right now in the markets that is not always true. We are sometimes seeing the AO and the price on the same bar at the same time. Yes?
When you say volatility, and a bunch of people talk about volatility, but today, or the last 4 months, or however long you want to call it seems to me that volatility is somewhat narrow again. I mean, obviously, the end of 08, when the VIX got up to 90, I mean, there was nothing like it.
I mean, like I said, in the beginning, we are living in such interesting times. Even an MBA in finance doesn't know what the hell's going on anymore. I mean, it's out there. But volatility, we need volatility to create the markets. What I'm referring to in many cases, though, is, let's say, 10, 15 years ago, you could place a stop in the soybeans for a nickel and go away for a few days and come back and know nothing had happened. We are seeing volatility as in ranges. We are seeing markets move much further than they used to, much faster than they used to. What we have and what are the markets? The markets the markets are us. They are a complete system of our belief systems. They are a natural behavioral system. The markets aren't technical. They're not fundamental. They are behavioral. We create the markets. And so with that behavior, we have to learn how to trade them. And they do change in time, just as behaviors change. But what's changed the most, especially for those of us that have been trading a long time, is the participation in the market. We used to trade, back when there was lots of floor traders and lots of things, going on, and before the internet was huge and all these IB platforms and things happening, the market was basically mostly U.S. traders. We had U.S. traders with the same belief systems, the same thoughts, kind of the same basic happening. We now have 24-hour markets. We have global participation. We have people from every country, every background, every religion, all trading. And as they come to the table, they all come with their own set of beliefs. And they trade the market based on that. So what we're seeing when I say volatility, I really mean change. I mean, we're seeing a melting pot of thoughts and personalities and belief systems where it used to be, a pretty much markets go up, we all make money, everything is good. That was kind of the theory. But now, I just want them to move. I don't care whether they go up, they go down, we want them to move. Now, in the stock market, that's different. Of course, we're looking at, it's just different now of what's happening. But traditionally, we wanted everything to go up because that is a focus of our economic wealth. If the stock market's going up, then everyone's doing well. We now know that that doesn't necessarily mean it as much as it used to. So, and again, I'm not going to get into that side of the world. I'm going to try to stay very pure on Profituni and what we do. So if momentum is increasing and it's higher than the previous AO bar, the bar will be green. So when you're looking at the AO, if it's a green bar, it was higher than the previous bar. If you look at the bar and it was red, then it was lower than the previous bar. So visually, what we really try to do is we are very visual traders. What is happening, the color, the price. My son at 7 knew that when the price bars were below the alligator, that you wanted to go short and sell it. And he knew when the alligator and the price bars were above, you wanted to buy it. Now, according, of course, to his grandfather Bill, well, anytime the market's above the green, I mean, it just, I have lots of stories that come home. But what I'm saying is that a 7-year-old could visually understand it without all these emotional attachments that we bring. Because we do. We bring all of our stuff with us. And the price bars will reflect the color of the AO. So when you've been looking at these charts I pulled up, if the price bar was green, your AO was green. If your price bar was red, your AO was red. Now the exception is if you had a blue bar. So if you had a squat bar present, you would have to look at the AO to look at the underlying color. Because the math of the squat bar, we'd rather have the computer do that for you than you try to figure that out. It's so simple to just look at the AO and see what the underlying color would be. Okay, so the awesome oscillator, I'm going to talk about a couple things that it does. We talked about the momentum. How many in here are at least familiar with Elliott wave and know that it exists? Now, how many of you it has driven crazy? How many of you has it made you lose money? Okay. It's very common that we will have clients that come to us and they're doing really well and all of a sudden they decide they need to learn some Elliott wave and everything goes to pot. It goes to pot. So in that, we need to have some better standards. So I use the Elliott wave only to help me know the underlying structure, just to know if I need to be conservative or aggressive. So here, peak of the AO, this is what happens. If you have the correct number of bars, between 100 and 140, you're going to have your tallest peak on the AO. And that's where it's going to be. So we can know that after you had a third wave or an impulsive wave, a correction comes after. Again, if you want to learn more, you can contact us. I don't want to get into Elliott wave today. But the wave 4 will always show up if you have the correct number of bars, and it will cross the 0 line on your AO. And to get to the correct number of bars, you simply change your time frames. So again, if you really want more information on this Trading Chaos First Edition, which is available through Trader's Library, obviously, we'll give you this information in great detail, and it is still pertinent to today's markets. So the Super AO signal on a chart, here we go. So this is it. All I want to show you here is what it looks like. It is going to be your square. So a green square is going to be a buy, and a red square is going to be a sell. And to create the Super AO signal, it's very simple. We need 3 consecutive colored bars after a color change. To have a buy would be 3 green. For a sell would be 3 red. Now, this is not an initiating signal, though. You must have been in the market with a fractal or a bearish or bullish divergent Wiseman signal. Okay, so clear. The Super AO is not an initiating signal. Now, those are the 3 signals that we look at to get in the market. We have a bullish, bearish, divergent bar. We've got the Super AO, and we have the fractal. Now, I haven't gone into exits again. We have a very limited amount of time today, and I wanted to give you a certain amount of information. Our exit strategies are pretty simple. For a bullish or bearish divergent bar, when you enter, your exit is the other end of the bar. So you know your initial risk if we're wrong. With the fractal trade, we will use the green line on the alligator. So we have a few things to do. And again, you can contact us or read our book if you want more information on the exits. Now I just want to talk a little about ETFs. In the beginning I mentioned that we work with all markets and all time frames. So it's across the board. It doesn't matter what you trade. ETFs are, I don't know if anyone doesn't know, I'm just going to give you some brief facts. They're exchange-traded funds that are much like stocks, and they are traded on the stock exchange. An ETF holds assets and trades close to the same price as the net value of its underlying assets. They do have some really great tax benefits. You'll have to check into that. It depends if you're trading currencies or different metals. They're going to have the same tax benefits or penalties as they would. You've got the wash sale, you've got long-term, short-term. So there's a lot going on worth you finding out about if you're trading them. You can sell short on a downtick, low cost. There's not excessive broker fees. And we like them. I have to say that we really like ETFs. In the past few years, watching some of the volatility of the futures markets, the small guy coming in that used to have $10,000 to trade can't come in and trade futures anymore. I mean, you could trade the minis or the micros, but you're not going to trade the markets. You know, with these margins, it's not possible. So we started broadening the horizon, so to speak. My dad used to be really almost strictly futures. I was always futures. Now he is strictly stocks and ETFs. He hasn't traded a future in 5 years. So we change, and as we change, sometimes the sectors that we want to trade fit our lifestyle more comfortably. The other is all sectors of the markets have ETFs. You can participate in volatile sectors with less risk. So if you want to trade the real estate sector, you want to trade the energy sector, you want to trade the indices, the S&P, the Dow, you have got places that you can do it even with leverage. You've got some of these, the Ultra Dog Dow, they're 2 to 1. So there are a lot of options in ETFs. So if you don't know about them, hopefully this is an introduction and you will look into them because we really like them.
What's the maximum leverage? 2 to 1?
Well, in some of the ultra funds, they had 2 to 1. Now, they've talked about pulling that back, so I'm not sure. There's so much regulations changing all the time that it's hard to keep up. But, type in ETFs in Google and you will get masses of information. The internets. Okay, so now I'm going to just kind of briefly go through some charts. I'm not going to spend a lot of time on the charts, but I want you to see how the indicators work. What we do and how we're using them. So on this particular chart, what I'm going to do is first go through ETFs, I think stocks, forex, and commodities. So I'm going to give you some examples of every market. Whatever market you trade, hopefully we'll pick or we'll be viewing one of those that will pique your interest or at least give you some new information. So this is an XLF. This is the spider, the financial spider. What we have here is a few entry points and exits. So here we've got a buy, another buy, and another buy. We have 2 add-on positions in this chart. The 2 add-on positions, we follow the market up. Alligator's wide open. We talked about earlier that we use the bullish or bearish divergent bar, the green line, and I also have what I call a trailing stop. I haven't executed any trailing stops in this presentation, so I won't be reviewing that here. I will be executing the exits with divergent bars and the green line. So with this particular trade here, the average price per share was $12.02, and we exited at $13.62. We had about $1.60 per share profit. Now, I've done this simply because you might have had 100 shares, you might have had 1,000 shares, you might have had 10,000 shares. What everybody's trading is differently, so just multiply the profit times how many shares that you would like to be trading. So here was the entry, was the bullish divergent bar, the super fractal, and a super AO. These 3 signals, we would like to get in the market, get our first 3 signals, and let it go. I do not like to keep adding on, adding on, adding on. When you do that, we run out of money. Your average price does not look so good, and we're having to get out much quicker. The next stock is material spiders. This particular chart, you see we got in here. Was our initial trade, was this divergent bar. We had angulation, did have a little bit of a risk. The next entry would be a fractal and a super AO. See, this market took off. Now, if anyone you want to ask, there's a divergent bar. I didn't take it as an exit. Well, 2 reasons. The first one is it didn't get hit. You put the order in, the next day the market goes below, it's gone. So the market continued in that pattern. Now here, the next one though, we have a stronger divergent bar, closed with the buyers. Here's our stop, and we exited there. So this was the average of $34.10 per share. Our profit was $3.61 per share. Not bad. And here's what he's talking about with the Ultra. Now this is the Ultra Russell 1000. Now we're not even looking at this move. We're just talking about buying in here. We have a bullish divergent bar. The distance between it and the price in the market is large enough to definitely give us an angulation. Buy here, we have another buy, and at that point this was still open. This presentation had to be turned in by a certain time, and so some of these I wanted to show you what it was like to still be in a market. Most of these were closed out of. This is one that we were still in at that point. Talk about the bearish divergent bars here along the way. Had you put your stop 1 tick below the low, you're still in. Now, I prefer once I'm in a trending market, which I consider a trending market, the wide open alligator, AO increasing to the buy side if we're in an up market. When I'm in a trending market and I've had all of my signals, I want to stay in, so I want to use the green line to keep me in the trend as long as possible. The divergent bars may not keep you in the trend. They may get you out early sometimes, or they may get you out at the best possible price. But overall, your green line is going to be able to keep you in a trend. The next is gold. Gold tracks here. We have buys, buy, buy, and our exit point on the green line. So we had the average price of $74.45 per share, and our profit was $15.45 per share per contract. Per share. QQQ is another one. Now this is a weekly chart. Through this presentation you're going to see daily, weekly, and monthly, and a few intradays. Again, it works on all time frames. If you are trading large amounts of money, you're probably not trading the daily time frame. You're going to want to trade the weekly or the monthly to allow you to maximize your move. So here's a weekly chart. We had our initial sell here. We had 3 bars outside the mouth. Add on, add on. Market pulled back up. If we were using this as our stop, which is the rule, we would not have been stopped out. And we were stopped out here on the green line. Again, with this trade, we had $45.60 average price. Our profit was $14.56 per share. Now, Forex facts. How many here trade Forex? Okay, Forex is very popular. Remember the old red light, green light? All you have to do is red buy, green sell. Well, Forex is very similar to that. So Forex, you've got a lot of Forex traders. 1% of Forex traders reach millionaire status. Very poor here. 4% make a living. 5% are breaking even every month with a few good runs. 36 have quit trading Forex and have never traded again. 54% are losing their accounts right now as we are speaking, as it trades 24 hours, 7 days a week. Traders are not educated well enough before entering the markets, and the average Forex trader replenishes account 3 times before discovering the truth, typically, that this is a tough place. The reason for that is that Forex markets are very difficult for the individual trader. If the individual trader is low risk, small amount of money, gets in there, it's not going to work. There are institutions, large banks, that's who's trading this market. If you don't have some good understanding of how to trade, some education, and the ability to stay with and withstand some swings, you're not going to make any money. So Forex, we've got a 15-minute chart here. Here's a couple entry points, 1, 2, followed it up, exited on the green line. So with this trade, it was a gain of 197 pips. Now I understand Forex is changing some of their rules, so the leverage is going to be changing possibly. The next Forex, we have one sell, another sell. We have an exit point here. So between this run, from the entry to here, you had an average here of 341 pips. The next run, you went short here on this fractal. You added on. You exited on the green line, another average of 523 pips. So not bad. Okay, we're running a little close on time, so I'm going to keep going, and then I'll be happy to answer any questions at the end. So the euro on the weekly, euro US dollar. We've got a weekly chart, entry. We have a bullish divergent. We have a SAO, which is a super AO. We've got a fractal. Market continues up, and we close below the green line, and that's our exit point. Average gain there was 1,464 pips. Commodity facts. Zero-sum game minus brokerage fees. So typically, commodity is supposed to be the zero-sum arena. Highly regulated for your protection. Electronic trading markets, 24-hour global participation, and liquid markets. So you do have a lot of opportunity here based on how you want to trade. The leverage is better than stocks, not necessarily in the ETFs. You're high risk in trading with large potential returns. It's used to hedge against other positions in various markets. And technical analysis and fundamentals still do apply with the commodities. We have an S&P 10-minute chart. On this chart, we've got an entry point here. We have a fractal breakout that's above the red line. We have another super AO buy. We have another buy here. And we have an exit on the red line. In this particular trade, this is a 10-minute chart. In about 4 hours, we had $4,900. Gold on the daily chart. Situation here, we have a fractal buy. And remember, if we don't have a divergent bar, if we're not in a counter trend trade, then the fractal is going to be my entry into the market. So I have a fractal entry, I have another buy, and I have an exit on the green line. Now I'm out. Next opportunity comes up. I get a new fractal buy. It's valid. I'm back into this trade. So in this original trade, we came out with about 3,200. The second trade, when we came in from the entry point here at 1,069, we had exited with 17,700 minus slippage and fees. So these are very possible. I mean, these are realistic. This was soybeans. Same thing here. We have your bearish divergent bar. You have your fractal to add on, and you have a super AO sell. You follow the market down. We get stopped out on a green line over $12,000. Now, when you're talking only 3 contracts, you're only looking at about $6,000 to $7,000 in margin after your initial night. So your return on investment here is very good. Australian dollar, we have a buy at the bottom from our bullish divergent bar with angulation. We have an add-on with a super AO signal here, and we have an exit with a bearish divergent bar on the top that kind of really pulled away with a squat bar. So I'm showing you an example of that. Here's your exit, here's your out. Had you waited on the green line here, that wouldn't have been as profitable. So we're looking at what's happening in the angle, we're looking at what's next to it, and that was a $39,000, almost $4,000 profit. Crude light, we have the initial entry here, another bullish divergent bar with angulation, risk's not too high. We enter with we add on with a super AO, we add on with another fractal, we carry this trade up. Again, we exited this one with a bearish divergent bar on the top, a little over 23,000 on that trade. Initial investment, again, when you've got 3 contracts, depending on where crude is and who your broker is, you still didn't have more than about 12,000 investment to come out with 23. So again, your return on investment is looking very good. British pound is on a weekly chart. You have a sell signal here. Our initial entry, which is a valid fractal. We have an add-on, another add-on. Market continues down. And this one we exit on the green line. So letting this trend run all the way out, starting to see the momentum change coming back up. Squat bar next to this, $74,000 on that run. Now, as you see in the larger time frames, a weekly time frame, we're going to be able, we're making more because we're looking at a bit bigger distance of time. The chart doesn't look any different than a 5-minute, a 10-minute, a weekly, or a daily. Stock trading facts. Traditionally, stocks have been used as long-term investing arena. We know that's not true anymore. Volatility has increased as well as the amount of day traders. That we do know is true. The difficulty shorting markets without correct conditions. Large volume and regular trading hours. Thousands of choices to fit your trading parameters. Technical and fundamental analysis applies. So as a stock trader, here's another arena depending on what you like. We all find something different. Some like certain colored cars. Some like certain kind of food. Some have gray hair, some have white hair, some have purple hair. We all have an affinity to liking something. Whatever market you choose to trade, hopefully is the arena that you do best in. So here on this particular chart, we've got buy, we're going to have a fractal buy, we have a super AO, we have another fractal buy, we have an exit here. On this particular run on Soho, we have 52.07 average price, $1.32 per share. And then in the same exact chart, market pulls down, we come back in, we have another run here, another buy, the same thing. We have a fractal, a super AO, another fractal, exit. That point at $1.47 per share profit. AMR, we have a few things going on in this chart. We've got a buy here on your bullish divergent bar. We have a buy on the AO and a buy on a fractal. Situation comes up, exit. That was $2.35 per share. On this particular case, we had $1.93, bullish divergent, exiting on a bearish divergent on both sides. So in between here, again, nice runs. Berkshire, this is one of my father's favorites. Even though they've had some hard times, he has been a diehard Berkshire person for quite a while. So on this particular chart, we've got our 3 entry points, and the profit per share was $12.66. Now this was Berkshire B, by the way, obviously with the price. Tricontinental, we've got buys, three signals to get in. Our exits up here at the top, 1078, average price of $1.56 profit. XLB Materials, this is a different, this is the second chart from the one before. We've got an entry of 3 entries at the top, all short signals, riding that all the way down, 360 profit. And now this particular chart, we did a stop and reverse because we do stop and reverses sometimes. There may be a point where we want to get and go with the market the other side. We had a divergent bar here, went long, added on, and exited out. So this is kind of one of those for the person that likes to be in the market all the time. You know, we have multiple ways of trading. Either you're in there all the time, you're in there for trends, you're in there to be particular, you're patient. We can trade pretty much all of those ways. This one was $1.83, and that was $3.60 per share in profit. On Apple, we were short from 146 down to the exit at 101. That was 45 a share. Then we had a buy-in at 103 and again back out 94.75 a share. So these are pretty good results for fairly simple trading, not having to do a lot, think a lot. Goldman Sachs, well, nobody, guess it's time to short that one now. But now we have a buy, and we have an exit here on the red line. Obviously, this was done a few weeks ago. I might not have included the chart. But we've got 55.20 on that run in Goldman Sachs. So you're starting to see that the indicators can bring a good bit of profit and can allow you to ride through. This was a weekly chart for Apple. Here was our buy. It was a fractal buy, a little aggressive, but it was above the green line. Our two add-ons and our exit, over $69 a share profit. Ford monthly. Now Ford, I just think Ford's, this is one of those charts that I like. Up. So with Ford, you had a buy on the bottom at 274. You had an additional buy at 216. At the time I'd done this, I had left it open. It was another one that we were still open. I believe Ford is surpassed where it was on that chart now. We had a pullback, but it's back above that today. So we would have been out and then back in. But on this particular run, you see the alligator's wide open. The price bars are above it. There's nowhere to be but long. You don't need an opinion here. We just need to be in the market. Common traits for a commodity trader. Common traits for commodity traders, and most of you have had some experience in finance or in money. You tend to be aggressive in the markets and not afraid of risk for good reward. I don't know many commodity traders that are not risky people. You also have to have starting capital. You cannot start trading commodities without starting capital. And we mentioned earlier, you've probably been successful in something in order to get you here. And you definitely don't like working for others. You don't follow traditional thinking most of the time. And you enjoy the challenge of the markets. Biggest problem for traders is their ego. I've spent a lot of time with New York floor traders, especially since some of the floors closed. I've done special classes for them. I've had 20 and 30 of them in our room at a time, trying to teach them how to go from being on the floor and making an easy 6 figures to trying to read a chart. And they can't. They can't, and it's very difficult because their set of belief systems came here. This is totally different, and they struggle. People that were completely successful in one arena now come to it here and can't make any money. So these are some of the traits that they had that made them successful, but we have to kind of mentor them. Stock traits, you're going to see more conservative approach in trading. You seek long-term security to invest in hard-earned money for a steady return. Traditionally, your 401ks, your investments, your retirements. Now, as we all know with what's going on right now, if you don't need any more proof than watching the news, it is time to take control of your own financial future. You cannot give it to someone else. You cannot let them manage these mutual funds, the money markets, the CDOs, the credit swaps, the derivatives. I mean, I can go on with the initials and where the money's going and who knows. You need to take care of your money. Dissatisfied with brokers and or money manager results. Again, so a lot of people with stocks, these are common things that have happened. They may or may not be educated in technical or fundamental analysis. A lot of stock traders just hear a tip. Oh yeah, somebody told me about that. And they're buying stocks. They're not educated, always. And they follow financial news networks for media and information. Now, if none of you know what CNN and FNBC stand for, it's Financial News Neurotic, can never be correct financial neurotic network. So that's how I look at that. Can never be correct financially neurotic news network. So that's how we don't watch the news. I don't watch the news. I don't want to see what they say. By the time they tell me what to buy and Kramer's banging his stuff, it's old. It's out of there. He's entertaining, but he's not my investment person. And they typically stock traders like a more consistent approach to life and trading. They're more in the box. Forex traders, new to markets and don't have a lot of education about trading. Usually a very small amount of startup capital. They have typically a pretty narrow view of the markets. They really don't understand. How many of you in this room have already bought 3 or 4 systems? Okay, how many of you remember the red light, green light? Yeah, okay. Forex is kind of the same thing for some people unless they're educated. The low risk tolerance for Forex. A lot of, you can get into Forex and you can decide, well, I only want my tick to be worth $5. Or I'm opening an account with $500 and I plan to make $1 million. Good luck. How many Richard Dennises are there? Very few. Typically, they have a low risk for tolerance and they also have a day job, but they would rather be trading. They follow the news and the financial news networks, that can never be correct, financially neurotic, and they seek quick wealth for a small investment. That typically is what draws them in. But in the old, what we think about, what happens is with most people, if they're really traders, they find that Forex brought them in the game and has opened their eyes to the horizons. There's not a lot of people making tons of money in Forex, I'm going to be honest. Our methods can work, but they need to be more long-term. Intraday is not the most profitable place for our indicators based on the volatility. Forex traders need to be able to get in the market, withstand the swings, and take it. But the ones that trade typically don't have that type of mentality or personality. 90% of traders fail. They cannot follow their system's rules due to fear and greed. Too much information and too many trading systems. You have too much coming in and you don't know which to do. Improper analysis or improper implementation of analysis. This is key. Improper analysis or improper implementation of your analysis. Taking risk without good reward assesses your risk-reward ratio before entering. So you really need to take a look at that. If I'm putting a $5,000 trade on and I've got an $8,000 account, doesn't make sense. Overtrading. Now here's a big one. I'm a trader. I have to trade, right? If I'm a trader, I'm trading every day. If you're a doctor, you're doing medicine. If you're a nurse, you're nursing. So as a trader, you're trading. Absolutely wrong. You need to trade when it's time to trade, when the situation's there, when the setup is there, and when you're ready. Not just because you want to trade to trade. And time frames, that's the other part. It's finding the time frame. A lot of people think one time frame is correct. Maybe it's not. We need to investigate. You need to find out what works best for you. Do not know how to handle the psychological aspects of trading and how to control their emotions and greed when fear take over. This is the number one issue with traders, is the psychological and emotional factors that come in. When I said earlier, trading is 99% psychological and about 1% technical. And it is true. The other thing is that a lot of times we don't have enough capital to sustain what we're trying to do and to be with the normal market volatility. So if you're trading with a very small amount of money, you're going to have a hard time standing with the market's normal movement. We impose our belief systems on the market that it can't go higher. How many of you thought gold wasn't going to go higher when it hit 1,000? How many of you said crude can't go any higher when it hit $100 a barrel? It was just your opinion. We don't know. So that's the point. We have to let go of our opinions and trade the market. Ego. We'd rather be right than make money. I can't tell you how many traders through the years would rather be right than make money. If only I could have had the money that they were willing to give up to be right. So these are some of the biggest reasons that traders fail. And these are things that you have to really focus on and get control on. Now, where are you going to trade best? Are you a trader? Are you an investor? These are questions you need to ask yourself. Are you short-term? Are you long-term? Do you want to be there for investing for your future? Are you trying to make your money each month? The next is, are you psychologically prepared? Psychologically prepared. When my father started talking about psychology over 20 years ago, they thought he was crazy. Now, anywhere you go, people will tell you the market's, it's all psychology. So we were the leaders in this, again, over 20 years ago, knowing that this is where it comes from. This is what keeps us from succeeding. Not the markets, and usually not our system. It's here. So define if you're an aggressive or a conservative trader. If you're an aggressive trader, you're not going to be trading oats. It's not going to work for you. If I tell you, hey, you need to paper trade oats for a month and get it down, you're going to look at me and laugh. If I know you're a floor trader, an S&P trader, I'm going to have to put you in an arena that works for your belief system. Know the market's personality and volatility. Understand that. Know where you are playing. Understand the playing field. Use the best time frame for your risk and your tolerance. A lot of people think if I intraday trade, well, then I have no risk. I go to sleep at night and all my money's there. But as you're sleeping at night, all those people that are trend trading, they're making money. You're missing it. you're missing out at what happens in between. So don't think that intraday trading is the only place to make money, because if you're an intraday trader, if you're right, you've got to be right big time to make any money. You know, typically you have more losing trades than winning trades, and if that's true, you better be hitting big on the winning. And how do you know the difference? So intraday trading may not always be the best arena for you. Have a realistic goal on your return on investment. Give yourself a realistic time frame and enough capital to achieve your return on investment. That's huge. Be fair. Give yourself time. Learn how to play the music, not just the notes. And we are almost to the end. So, the next is successful trader qualities. These are just a few things. I've been doing this 17 years. Just reminded when I was talking earlier that 17 years I've been in this business. I've seen a lot happen. And some of the things that I've noted through all the traders that we have trained and worked with are these: patience, accepting and introspective, intelligent with some good intuition, risk taker. You have to see opportunity and know when to act. And the key point here, you must be as comfortable with your losses as you are with your wins. If you're not going to be successful. You have to understand that winning and losing are part of the game. If you're not willing to lose, you shouldn't play. Simple. You have to trade in the right arena for your personality type. And you want to be, mostly traders are independent. They think out of the box. They're not in the tribe with everybody else. They're taking risk. You're actually getting paid to take risk. You know, we are raised thinking, don't touch that, don't do this, it's hot. Risk, no risk. We're risk adverse. Well, traders have to not be. We can be loss adverse, but not risk adverse. The ability to lose, the ability to cut your losses quickly and to stay with the trend, trust the market. They trust the market and they trust their system. A good trader knows that you're going to have some losing trades, and that's part of the game. They don't quit the system because they had losing trades. They keep going. Now, there is a time to reevaluate, of course, but typically you will have losses. And the most thing, this is really important. You know, there's a lot less here than meets the eye. If everyone here knows who Richard Dennis is, the famous turtle trader, well, he's the guy that took $1,600 he borrowed from a family member and parlayed it into over 200 million, I think, 20 million. Anyway, huge amounts of money. And one of the things that they asked him about this and about the market, and he said, there's a lot less here than meets the eye, which means we overcomplicate everything. Well, it looks like this, well, it should do this, and the news said it's going here, and it's all BS. What does the chart say? The price is at 88.50? That's reality. The price is at 88.50. So the last thing I want to leave you with is something that we say to people, and this is really the key to trading. And it's simple: want what the market wants. If you can let go of your beliefs, let go of your opinions, and just want what the market wants, you can follow it like the tail of the dog. So hopefully today I have given you some new information. We enjoy what we do. I've been teaching and trading 17 years. My husband and I, Marcus, run the business at Profitunity. My father has retired. He still trades every day. We love it. We hope that you would all be successful traders and that this is the next step. We know that in one weekend you're not going to learn to trade, but the information that you've received here this weekend will allow you to take that next step to the higher level and do the transcending experience like the hydrogen and the oxygen to a successful trader. So thank you all for coming.